Hey guys, so let's move on. All right, guys, so we're back. Okay, I stopped at there. So I was talking about the LBank fees. All right, let's start with rolling market. Basically, they said your rolling market in the market order, you're going through a market order. Basically, you take liquidity from the order book. All right, so you'll be taking liquidity from the order book, and for limit order, you are making liquidity by adding an order to the order book. All right, so I'm sure that's self-explanatory. I'll explain it better. Higher taker fee and higher maker fee. You understand? So on lower maker fee. So once you hear taker fee, you know you are talking about market orders. All right. So taker fee applies to market orders. See, you can see here is 0.06%. It's quite very low on LBank. And then on lower maker fee and even lower one on the maker fee because that's when it's on the limit order. All right, so you have 0.02%. When to use, when speed is critical and you must enter and exit now or exit now order. When to use, when speed is critical and you must enter or exit now. After you've done your analysis and you feel that okay, you have a strong conviction towards your analysis and you feel that if you enter the market and you're going to make some profits, boom, you can go in with a market order. So that's when to use a market order. All right, so when to use a limited, you say when price is more important than immediate execution. Basically, if you do your analysis properly, you do your analysis properly, and you wait for price to reach that, you wait for market to reach your price limit, your price, or to trigger your price, and you're good to go. A market order buys you speed at the potential cost of price slippage. Which means that slippage. I'll also explain this to you guys. And a limit order buys you price at the potential cost of speed. You understand? The limit orders it takes a while before it's used, but it buys you price at the potential order of speed. So the architect's primary tool. All right, precision and control with limit orders. This is why most traders or most professional traders use limit orders instead. So this diagram explains everything, and this right up here explains everything. All right. Total price. They want to why professionals default to limit order. They want total price control, prevent overpaying, buying or underselling. Understand? They want total price control. Like I said, with limit orders, you have price control. You have more price control. So it prevents overpaying due to all these slippages and all that, and it avoids underselling. Do you get where you want to sell? When you want to buy, it avoids overpaying, and when you want to sell, it advises on the selling. All right, yeah, it stops on the selling. Yeah, it mitigates slippage, protects your entry exits from market volatility. That's basically what slippage. It protects your entry or exits from market volatility. When the market is volatile, you might feel that you're entering at this particular price, at this set market price. before everything the order fills up, before it boom, the price, the market is volatile. Now either goes higher or goes lower. You understand? So there's slippage. That little millisecond or minute or whatever it takes to fill, there's a little slippage and go down. Understand? So that difference now might affect you. So it mitigates slippage. All right. So it reduces fees. Basically, you're taking a maker fee, lower maker fees on LBank. So there is, and you can see that the LBank fees are 0.02, taking it post only order. So definition what the post only order is. This one is beginners. Just don't bother about it, but like I'll just briefly read what I put down here for you guys. So it's a type of limit order that is only accepted if it does not immediately match with an existing order. You understand? If it will execute instantly as a taker would instead. I repeat, is a type of limit order that is only accepted if it does not immediately match with an existing order. Alright? Execute instantly as taker, the order is cancelled instead. Alright, what is the benefit? It guarantees you'll be a maker and pay the lowest possible fees. Alright? Possible fees here. It is the ultimate tool for preventing accidents and ensuring you add liquidity. This one is just is basically don't worry about this for beginners like you. Alright, so let's go to the next thing. Alright, so we are talking about stop loss here. Alright, the safety net. A stop loss is a non-negotiable insurance. Alright, a stop loss is a non-negotiable insurance. What is it? A stop loss is a type of trigger order that instructs the exchange. You know, I said this before previously. It's a type of trigger order that instructs the exchange to exit your position automatically. Type of trigger order that instructs the exchange to exit your position automatically if the price moves against you to a predetermined level. This is what I was basically saying before. All right. So a stop loss is a type of trigger the exchange to exit your position automatically if the price moves against you to a predetermined level. All right, that's what the stop loss is basically. So you already explained what the stop loss is, how it works on LBank. You set a trigger price, e.g., a mark price. When the market hits this price, the system automatically places an order to close your position. Alright, the system automatically places an order to close your position. This can be a stop market order which exits immediately at the next price, or a stop limit order which exits at a specific price. Alright, or better, not you. Alright, so that's what it is. So if price starts going against you, basically once you set a mark price and price gets to that region and it's going against you, it takes you out of the market. Alright. So the system automatically places an order to close your position so that you can be safe and you don't get liquidated. Alright, so let's use to show what this is. Alright. Now see, here we have an uptrend, we have a pullback. Like what did you from yesterday when we did market structure, higher highs, higher. and higher lows. So this is an uptrend. Then there was a reversal here. It broke structure. This is a COCH, a change of character. It broke structure, came down, lower highs and lower lows, came down. All right, now, so see this line here now. If you're looking at the graph, this line here is our entry price. All right. To explain stop loss, this line here is entry. This is where the price is at the current limits. All right. The current limit. So this is where you put your stop loss, just below the entry price, just below the entry price. Not too far. Then this is where your liquidation is. All right. This is your liquidation price. So that means if your stop loss was not here, if this price, maybe you predicted that, okay, yeah, it's going to be bullish, yeah, the price is going to go higher. Now if suddenly something happens and reverse, like it has reversed here, like it has reversed here, once price comes down and reaches the stop loss, it will take you out of the market. So you'd have just lost a little, maybe you have just lost the margin that you put. All right, it shouldn't affect your whole account, or you've just lost a particular amount that you decided that, okay, this is what you can afford to lose. All right, that's just risk management. That's why stop loss is very important. All right, so if you not put it now, boom, your price will keep going down till it liquidates you. This is your liquidation price down here, where you are taken out of the market of your margin. You can see that. All right, you can see that total loss of the money. So yeah, all this one is controlled. Do you get stop loss? All right, so that is understood. You can survive small planned losses. You cannot survive a liquidation. Very important that you know you can survive small planned losses, but you cannot survive a liquidation. A stop loss ensures you exit on your own terms, not the market. All right, so you can see that a stop loss ensures that you exit on your own terms and not the market's terms. All right, so let's go to the next thing. All right, so talking about liquidation, let's explain what liquidation is. All right, so if you hear, let me say liquidation, liquidated, you get liquidated, liquidation, and all that. So let me briefly explain what liquidation is to you so that you can understand. Liquidation is the forcible closure of the trader's leveraged position by the exchange. Do you hear that? It's the forcible closure of the trader's leveraged position by the exchange. You understand? Okay, now, so even before I explain to you, we have isolated margin and cross margin. All right, so in isolated margin, always your liquidation price is always higher. And so liquidation is basic. When you enter a trade, when you lose your money, that's liquidation. So, in a layman's term, make I put out, make I put out a way of way on go understand. In a layman's term, liquidation are when you lose your money. Now, when you lose your money, that's liquidation for you. When you lose your money, put your money inside trade and you lose it. That is it. So forget all this English I'm speaking here. Do you understand? This occurs when the trader's margin can no longer cover the ongoing losses of the trade. Alright. This occurs when the trader's margin can no longer. So if you go in with an isolated margin, you might be safer because, okay, if it's that $10 you use put in isolated margin, is that $10 that will be liquidated. But if you're using a cross margin and you're not careful, you have the stop losses and you don't do a proper risk management calculation and all that very, very well, you lose your whole money in your futures account. You get liquidated once and for all. That is just the way it is. The market no dey pity anybody. No dey pity anybody, guy. Alright, so the key components. The initial margin, the capital you put up in a position. whatever capital. So you guys try and understand. I'm gonna try and understand this thing now. Whatever capital you put up in a position, that's your initial margin. All right. Initial capital you in a, put up to open the position. All right. That's your margin. It's called margin. All right. Then maintenance margin, the minimum amount of collateral required to keep the position open. You know what the collateral damage is now. So I'm sure you guys have watched that. And I don't see that movie. All right. So the minimum amount of collateral required to keep the position open is a fraction of your initial margin. All right. Just a fraction. On LBank, it can be as low as 0.5% for high leverage. The trigger liquidation happens when your position losses is through your initial margin. Alright, so did you hear that? Liquidation happens when your position losses each through your initial margin and breach maintenance margin threshold. Okay, so I'm guessing we got that. So let me take maintenance margin again. But you know what the initial margin is, the capital you put up in the position. The maintenance margin is the minimum amount of collateral required to keep the position open. Alright? It's a fraction of your initial margin. E.g., on LBank, it can be as low as 0.5% for high leverage. Alright. So the trigger, liquidation margin. Liquidation happens when your positions losses hit your initial margin and breach the maintenance margin threshold. Okay, so let's use this diagram to explain it better. It's called the margin meter. Alright, so this is your initial margin. This is the margin. Okay, this is your initial margin. So initial margin 100% here. Okay, so maintenance margin threshold. You can see unrealized loss liquidation. Alright, you can see that I can call this maintenance margin threshold where you put your stop loss. This is basically where you put your stop loss. So once you start losing, and it gets a trigger so that you don't get liquidated. Alright. So liquidation is not random events. It's a mathematical certainty if the market moves against you far enough. The exchange risk engine operates to prevent a negative balance. So that's just the way it works. Yes, that's just the way it works. Moving on to the next thing. Alright, we're going to go into some maths. We're going to go into some maths. So yeah, just give me a few seconds. I'll come back and take you guys. Let me get something quickly. We're going to go into some maths now. Listen to, I don't know if my music is loud enough. Listen to some music. Give me some minutes. We'll continue shortly. Be back shortly. Hey guys, just a moment. Okay. All right, let's get back to it. I'm back here. All right. So I had to take that a little break. What's a break? My head was banging. I've been on this since morning, since early morning, all day. It's not been easy. All right, the mathematical survival, calculating your liquidation price. So you can see from the formula here, long position, liquidation price. For the formula here, we have liquidation price equals your entry price. All right, you can see that equals your entry price minus your initial margin. And that was your initial margin. Your entry price is basically okay. For instance, BTC is at 50. I always use this BTC example. BTC is at $50,000. All right, so and that's your entry price. Maybe you want to enter go into the market with BTC at 50,000. So yeah, that's your entry price. The initial margin is the amount you are willing to risk. Understand? The amount you're willing to pay. Initial margin divided by your position size. All right, divided by your position size. The position size is basically your margin multiplied by your leverage, all right, then times maintenance margin rate. All right, so you calculate this first, position size minus maintenance margin rate. Then you now divide initial margin, you now divide it, you now divide it by initial. What's the word? How to take this out? So the initial margin now comes in and divides the position size minus maintenance. After you must have multiplied the position size times maintenance margin rate. Then you now minus the total of this from your entry point. This is just a simplified formula for clarity. So the exact calculation is just includes more things like fees and more complex variables and all that. So this is just uh, a simple way so that you guys wouldn't get confused. Practical examples with someone straight, someone annual long trade on Ethereum. All right, so she long trade on Ethereum. Her pair was 8 USDT. So our entry price, you can see our entry price was $3,000. Our entry price was $3,000. Margin, your margin is the money you want to risk, the money you want to use for the trade. Your margin is your capital. So she went in with $500. She went in with $500. And her leverage is into 5x. So your position size, your notional position size is 2005. Like I said, is 500 times 5. 5x basically means 5 times whatever your margin is, your capital is, your margin is. That's what uh, leverage is. That's when you get 5x, 10x, 20x, 30x, 50x, and all that. Just times that, so you can imagine some people getting to that high. Alright, so it's 5x times 500, so you get 2,500. So that's the position size. Then your maintenance margin is 1%. Alright, maintenance margin of the risk is 0.01. Alright, so here's the calculation. You can see it, and we arrived at $2,980, which is about $3,000. So that would be your liquidation price. So once the price gets to 2,900, even though you enter the $3,000, because of the whole other variables and everything, you understand? So boom, you're gone. See, entry price 3,000, national price, the liquidation trigger 2,980. That means your money is gone. Ó ti lọ, ó ti lọ. So yeah, key insights. Higher leverage dramatically reduces the distance between your entry price and your liquidation. Alright, so as you go on a higher leverage, your chances of liquidation becomes so low. It reduces it becomes so high. I mean, so be careful out there once you're doing with your leverages. So doubling leverage halves your room for error. So let's go to the next thing. As I'm sure. Don't worry, I'll show you all this. We'll navigate the LBank system today. We're going to navigate it. So you guys are going to see your shield against liquidation, the pre-trade protocol. All right, so this is just the process. Professional workflow. All right. Before placing any trade, use the LBank futures calculator to simulate the outcome. All right. Enter your intended trade type, long, short, leverage, entry price, exit price, and quantity. Analyze the output. Analyze the output. The calculator provides three critical metrics: initial margin, the P&L, and ROI, return of investment, ROE, I mean, your potential profit. That is your initial margin. That's the capital required to open the trade. This is what the calculator provides for you. All right, your P&L and ROE. That's your potential loss and your return on equity. All right, that's what ROE means. For potential profit slash loss and return on equity. All right, then your liquidation price, the exact price at which you automatically close. All right. All right. So from this diagram, you can see once we get on Elba, as you can see, it's open here. This is what the Elba interface looks like. We'll come back to it. All right. You can see your leverage 10x for long. Your leverage 10x. So your entry price is $4,200. Um, your exit price is $4,500. Quantity 1x. Initial margin 420 $420. All right, $420. P&L $300. And liquidation price you can see and all that. So don't worry, I'll show you guys better on the platform, on the LBank platform. All right, so this futures trading. All right, so there are major killers, the things you should know. All right, it's futures trading. I call it hidden killers. No, and the hidden killer one is the frictional cost of slippage. The frictional cost of slippage. All right, so what's the definition of slippage in general? All right, slippage is the difference between the expected price of a trade and the actual price at which the trade is executed. All right, that is what slippage is basically. When you hear me say slippage, this is what slippage is. So slippage is the difference between the expected price of a trade and the actual price at which the trade is executed. Okay, so I'm talking about slippage. That is what it is basically. So how it occurs when you place in large markets order in markets with low liquidity. That's there are no planes, there's no much liquidity, there's no plenty people in the market. Understand? A thin order book. Understand? That's what we mean by low liquidity. A thin order book. That's maybe that position at that particular time. There's no much activity. Order books is very thin. The orders get filled at multiple progressively worse prices. You understand? Multiple progressive example. You place a market buy for 10 BCC. You come and you have large funds. You want to buy 10 BCC. So you place a market buy for you. 10 BCC. The best ask price is 2 bit. It has 2 BCC. The best ask price has 2 BTC. You understand? Those ones are filled. Then it has 3 BTC because it doesn't have the ask price. The person that has a 2 BTC doesn't have a up to your 10 BTC. So the next one, after it fills the 2 BTC, the next best ask price is 3 BTC. Those ones are free. The remaining 5 BTC, that's how it goes. You understand? So your average entry price is significantly worse than the price you saw initially. All right. So it's basically the average of all these prices. So see this visual infographic, we're walking through the book now. 10 BCT, 40,000. See the first one, 2 BCT, that this ask price. It has 40,000. Then the next best one was for 40,005. You understand? Then the next one was 40,010. Like that. So that's slippage. That's the slippage we're talking about. Once you add all this and find an average slip. Slippage is the direct text on and the larger your order, the lower the market's liquidity and the higher the tax. Limit orders are the primary defense. This is why a lot of people go and limit order. You know. So yeah. Or hidden killer drag of trading fees. Alright, the common misconception is traders usually assume that fees are calculated on their margin. That's very wrong. Understand? So traders usually assume that fees are calculated. Common misconception. Most traders say that fees are calculated, but the reality is fees are calculated on the total notional value of the position. When we say notional value of the position, it's basically the margin times your leverage. That's what is your $10 times the leverage. If it's 10x, 10 times 10, that's 28, $20. Sorry, 10 times 10, 100. So the amount of fee erosion. LBank fee structure, for example, taker fee is 0.06. Remember, taker fee is when you're going in on the market order, and maker fee is when you're going in on a limit order 0.02% of your margin. All right. So scenario, you use $100 of margin with a 10x leverage to open a $1,000 position. All right. Take our cost around round trip entry. See, see the entry fee once when you finally enter that particular 0.06 of $1,000, which is 0.60. Exit fee another 0.06 of that $1,000. 0.06. You can see total fee. 1.2. This is for taker. They are going in the market order. The impact, the 1.2 bidder and two $1.2 fee on your $100 capital is 1.2% loss to friction alone. 10 of such trades in a day and you have lost 12% of your accounts before factoring in any market losses. Just imagine. Okay. So imagine $100 trade and $1.2 is taken as a total fee because they're basically charging it from your notional fee. That's your total position size. They're not taking it on your margin, hmm? Or your notional value. They're not taking it on your margin. So that's the way it is. This diagram basically explains it. So leverage magnifies fees just as it magnifies P and L. Consistently paying taker fees is a significant self-inflicted headwind to your profitability. All right, so hitting killer three. Ooh. Since perpetual futures, the rhythmic cost of funding rate. Since perpetual futures have this, the funding rate mechanism that anchors the futures price to purple. Sorry guys. Oh, I'm just exhausted. Since mutual futures have the expiry dates, the funding rate is a mechanism that anchors the futures price to underlying spot price. That's basically purpose. It is a periodic payment exchange directly between traders holding long and short positions. Payments occurs every 8 hours. This is not to I just put it there so you guys can get a big picture. So but not that important for now. So let's move on to the next thing. So the traders asset from speculation to a system of discipline. Right, so let's see this diagram here. Foundation, you use isolated margin. This is what as a trader, as a beginner, this is the process. This is how you should do it. This is how you should go about it. Use isolated margin to bound the risk and segregate capital. Alright. So use isolated margin basically. Use isolated margin as your starting. Then you can default to use your execution limits orders, limits orders. Management, a stop loss on every trade is a must. Alright, it's non-negotiable. A stop loss on every trade. Then use the futures calculator to know your liquidation price. Alright, use the futures calculator to know it's always there. We'll do it. Then mastery account for hidden costs, leakage fees, and funding rates. Alright, so this is basically the whole process I think you should go through. So, uh, I'm sure you guys have enjoyed, even though they were hitches stops due to some technical issues, but I'm sure you guys have gotten the basic fundamentals of futures on an exchange and on how to trade futures on an exchange and all. All right. So sure you guys understand it. So now we'll go and show you a platform so you can see how and what I mean by all this I've said. All right, so you guys need to pay attention here. You can see BTC is going on a 15 minutes and a 15-minute time frame. You can see it's going down. Let me change this to yeah. Okay. See, on a 15-minute time frame is you can see it's going down. Like I told you guys, multi-frame. I was talking about multi-frame analysis yesterday. You can see how it's going down. All right, so hold on, let this load. I just want to start from. Let me just do a brief navigation of the platform so you can see. I think I'm having this. Why is it not opening? All right, so when you come to the LBank page, once you log in, don't worry. I know I said I'm going to share and do a short video and put it on my register for LBank properly. But for now, let's just go through this. So this video is going to be there. All right, so once you come, you can see this is what it is on your desktop. This is how it looks on your desktop. I know most people use their phones to trade, so basically the videos I'll be sharing will be via phones. Then I'll still do ones for the system too. Okay, so this is the LBank platform. This is what it looks like. For here, it says buy crypto. You can see one click buy, support deposit via bank card, fix another payment method. Then say P2P trading. So basically, you can, if you're good at P2P or you know how to do P2P trading, maybe I'll also do a video on how to do P2P trading. Basically, I'll do a video on that. I'll do a video on the different sections of using LBank, short videos, so that you wouldn't have an extremely long video. Just something briefly look at, and So this is where you come to this section. You want to buy and deposit. You deposit crypto into your sports wallet onto your account. Or you can just click on deposit here. See, all right, sports, margin, futures, da da da. You have different options. You have different options. Okay, you can see Omni account, earn account. It has different so once you deposit, do you want it to go to your what a sports account? Do you want it to go to your matching, your futures account, your omni account, and account? You can interchange in between accounts. All right, so you can interchange you can send them, and it's free. Once you send in, once you deposit in one of the accounts, you can send the your assets into any account that you want to for free. All right, that's what deposited. And when you want to withdraw, once you withdraw your money, or maybe you've made some cool cash from your trades and you want to withdraw your funds, basically this is where you click. This is where you click, withdraw your funds, and it gives you options of withdrawal. All right, it gives you options of withdrawal. Where was that? So sorry, this was the wallet, yeah. So it gives you the options of withdrawal. Then you want to transfer. All right. So deposit cryptocurrency, one click buy P2P trading. Like I said, I'll do a video on P2P trading. I'll even do a video on how to deposit properly. All right, so to show you guys how to really use this amazing platform. Okay, so that's one of the tabs. Then that's you have markets, basically where you see understand everything you need to know, all the available cryptocurrencies that we have. You come here, you can see them, everything, what's going on. That was our markets. But we're not, then you want futures, that's what we're more interested in, and that's what we're coming back to. That's what I've been teaching today. All right, so for futures, you come here, you click on futures, you go straight. I don't know what this is showing. Okay, I think it didn't load properly. It's supposed to show the different. It's supposed to show the different cryptocurrency pairs. Let me try reloading it to go properly this time. Let's hold on and wait for that. Okay, you can see there are lots of perks as you join. This is still loading. I don't know why my network is kind of messy today. Aha, here we go. All right. As I said, features. You can see BTC perpetual. What do you mean by PEP is perpetual contract. Anyway, you see perpetual contract on an exchange, just know that we're talking about futures. So that's the future